Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Roger Holman and Rehana Earle.
Welcome to The Tax Factor, the UK's top tax podcast. I'm Roger Holman.
And I'm Rehana Earle.
Following on from last week's episode with media stars Nimesh and Matt, Rehana and I are hoping not to sound too much like the B team, even if, with my throat infection, I sound a bit like Barry White. That said, I'm told my appearance on Songs of Praise Choir of the Year stands me in good stead with these media moguls. Well, I was in the audience in front of the judges, so that counts in my view. And congratulations to Rehana, who has taken over as head of the global mobility team here at Blick Rothenberg. I know there's an international story coming up.
Thank you very much, Roger. And I hope your throat holds up through the episode. And we do have a French story on the way later. However, back to the elephant in the tax room, the ever-looming budget. So one of the stories that has definitely been taking a precedent in the news over the last few days is the potential increase in employer NIC. That's definitely the big story at the moment. And it was hinted at over the weekend by Business Secretary Jonathan Reynolds that a rise might be on the cards. Reeves has done the same, and in questioning Keir Starmer on various programmes, he has not denied it. Reports are now saying that Reeves needs to find 40 billion, so not that 22 billion figure that has been bounded about quite a bit over the past few months, because she wants to fund all day-to-day spending and investment through taxes and not through borrowing. And the 22 billion would only enable the government to cover current spending needs. So with the need to actually get 40 billion into the coffers to avoid any real-time cuts to departments, obviously there's going to have to be a shake-up somewhere. And it's this fiscal rule around not using the borrowing that is binding the government, and why they're going to have to seek some welfare savings as well as putting in some tax rises. So the employer national insurance rise could meet a big chunk of this black hole. But as we all might recall, Labour promised during both their election and in their manifesto that they weren't going to raise taxes for, in quotes, working people. So, Roger, do you think that raising the employer NIC rate is actually going to break this promise?
Well, I'm not sure that it would necessarily break the promise. And Mr. Reynolds made it clear that during the election campaign, Labour only committed to keeping the rate the same for working people. And that's as a reference to employees, not to the employers. Now, currently, employers pay national insurance at 13.8%, and that rate hasn't changed since April 2018. And in the year to April 24, employers paid over £107 billion in employer NICs. According to the stats that we've seen, if Labour added another 1% to employer NIC, that would raise around 8.4 billion for the current tax year. Now, the one thing that is really getting us is that Labour has never really defined working people. And so a rise on employer NICs doesn't strictly represent a tax on workers. I've recently read an article by John Stepek at Bloomberg where he was talking about the incidence of taxation. Now, a lot of people are probably rolling their eyes, oh, it's a tax advisor talking tax again. But actually, it's a really interesting topic, particularly around this point. So realistically, the people that actually pay tax are individuals. Companies, although they have a legal personality, don't really pay tax. It's really either the shareholders, employees, or their customers. So where national insurance is concerned, it's almost certainly the working people that will ultimately suffer, either through lower pay rises or lower pension contributions.
Yeah, that's very interesting, Roger. And actually, I think I 100% sort of agree with that, as well as the Institute of Fiscal Studies, who also seem to agree with that same view, that in the long term, actually, they've said 2 out of 3 employer NIC increases were also shifted onto employees' wages. So it's probably that combination, as you said, of everything. But ultimately, employees will, in some way, shape or form, be the ones that suffer the burden of the employer NIC rate. And as we sort of mentioned, pensions in many ways, shapes and forms, seem to also be a target through the budget, whether that's restricting tax relief or in some other way. And actually, what we could find is that Labour apply employer employers nick to pension contributions that companies make on behalf of their employees, and introducing a national insurance contribution to those pension contributions made by employers at the full 13.8% could raise as much as 17 billion a year, according to the IFS. So not a small sum of money. At a time, though, when Rachel Reeves is obviously trying to attract investment from business into the UK. They had a big summit a week or so ago trying to get business to put their money into the UK. The question is now going to be, I think, whether or not that will impact that investment and whether, an increase in employer costs will put some businesses off or not. There's definitely going to be some kind of trickle-down effect. And I think we'll see that businesses won't be employing as many people, or they certainly won't be able to afford to give pay rises potentially in the same way. And whilst some bigger businesses might be able to shoulder some of these rises, when we think about small and family-run businesses, which prop up quite a large part of the UK economy, they're certainly going to suffer if the rules changes. And I think there's probably also some industries that will suffer perhaps more than others, those such as retail and manufacturing, or those industries that work on quite tight margins might also be badly hit. 2 weeks today, actually, until the budget. Speculation continues to be very rife, but the expectation is, I think we will see that nick raise given some of the numbers that are being bandied about. There'll be something on pensions, potentially capital gains, potentially inheritance tax. And so the question remains, will we see some manifesto promises broken? But with that speculation, Roger, what do you think? What would you do?
Well, I think the first thing I'd look at is actually proper CGT reform. Now, there's been a lot of news bandied about the various places, financial press, about CGT rates having to go up, perhaps to income tax rates. And I don't see that happening personally. There's too much evidence to suggest that that would actually lose the government money. But the problem with CGT as it stands is kind of twofold. Firstly, it looks out of line with those hard workers that Labour are trying to say they are helping. And the other side of it is that it's a flat rate of tax that doesn't actually reflect the time value of money or inflation. So we could look at going back to my early career where CGT was actually taxed at income tax rates, but with allowances for inflation. The problem with this is that it leads to increased complexity, question marks over when things were acquired, and other similar sort of issues. What I'd like to see is for us to move to a more US kind of model on CGT. Here we could look to tax short-term gains at income tax levels and longer-term gains at CGT rates. We can leave the current rates as they are, and it just means that those capital gains that are really a bit more like income, something you've held for 1 or 2 years, those can be taxed at income tax rates. Now, this gets around the political argument of income being converted to lower rate capital gains, while also potentially raising a bit of extra tax, and without badly affecting the headline rate. Because in my world, the CGT rate wouldn't actually change. Of course, you hinted at breaking manifesto promises, and I would probably do that if I really wanted to raise money. To do that, I would increase the basic rate of income tax. Now, that's the rate that the most people across the country actually pay. Now, if I was going to do that, if I was a Labour government, I would also want to significantly increase the personal allowance, because that will allow for the fact that this increase will affect those on the lowest incomes. But ultimately, this is the main and almost only way a government can really move the dial on the amount of tax they take. Now, if we're going to play around with income tax, I'd also get rid of these stupid marginal rates that we find in our tax systems. Things like the higher income child benefit charge, a favourite of our podcast, and the reduction of the personal allowance for those with incomes over 100,000. Now, in the latter, I'd probably combine that with dropping the level at which the additional rate is paid. For me, simplicity in a tax system is far more important. Some other things that we might see, but I'm not sure that I would do, are, and I do apologise for covering some old ground, looking at removing the IHT exemption for residuary pension funds on death. Now, that's only going to work if we don't bring back the lifetime allowance. In my view, it's one or the other. We could look at introducing progressive bands of IHT starting at 20 or 25% and perhaps rising to 50%. But the problem with that is it complicates the whole probate process, and that's at a time when it should be the simplest as possible. Personally, I'd just get rid of the residence nil rate band. It's an overly complicated mechanism for IHT, and then reduce the rate to 20%. I think you'd find far fewer people avoiding IHT if it was a much lower rate. Could look at combining and reducing other reliefs, maybe just one annual gift relief. Again, this could be quite a complicated and not really tax-raising measure. And lastly, on inheritance tax, we could see some changes around business relief and agricultural relief, which I know I've covered off before, but very briefly, it could mean some changes around qualification criteria for both of these, and perhaps something around aim shares, which seems an easy way to abuse the system.
Very interesting, Roger. We will have to wait and see whether any of your recommendations are taken up in the future. Watch this space, Roger, for the next Chancellor. Bringing a more global spin on things, which I think is always an area of interest for me as I work in global mobility. Obviously, it's clear that the UK aren't the only ones who are tackling deficits at the moment and aren't the only ones that need to look to raise more tax revenue to match spending and investment needs. And one particular example that I mentioned actually in the episode that I did a few weeks ago with Ellie was that France were looking to implement some tax increases themselves following their own budgeting woes. And they have recently announced, and this is kind of being debated at the moment, those earning over €200,000, which is about kind of £209,000 at current exchange rates as a single taxpayer, and €500,000, which is about £418,000 as a couple, will have to pay a minimum rate of 20% of their total income for the next 3 years. Now, actually, 20% probably seems quite low to us because our additional rate tax kicks in quite early at 45%. But what this will do is for any Brits who are living in France and taking advantage, obviously, of the very beneficial expat tax regimes that are currently in place in France, as well as general high net worth payers, are going to be impacted by these changes to the tax rules. And what we'll see is personal tax higher rate charge. Apparently, it's being brought in for 3 years, covering the current 2024 tax year, and is supposed to be a temporary measure.
A bit like income tax was a temporary measure.
Well, yes, that's exactly it, Roger. My colleague Vanessa Kistu, who is the head of our French desk and works in the global mobility team, said exactly the same thing, that these measures might not, in fact, be temporary. And the French authorities think they can raise 2 billion from these changes. And so, given kind of where they are fiscally at the moment, whether or not that will suddenly disappear in a few years' time, we will have to wait and see. And for those potentially looking to leave France, if they don't want to be caught by the new changes, they have to consider an exit tax, especially where they have wealth over €800,000 with an exit tax rate of 30%. So, yeah, I mean, something potentially for certainly Brits in France or any other nationals in France to think about if they are not keen on this potential rise in tax rates over there. And the same is going to be happening to businesses in France. So they're also being hit with a supposedly temporary increase in corporation tax rate, which will apply to profits derived in France and is expected to raise a total of 12 billion over 25 and 26. I suppose the interesting thing is whether or not we'll see businesses in France kind of move operations out temporarily to other countries, or whether they will just stick with the tax rises. Let's see kind of where that goes. I think it's always interesting watching other tax authorities and governments and seeing what they're doing. The French will also kind of like to play about with their wealth taxes. And that's also something that the UK have been talking about, Roger, a wealth tax. So what do you think about that?
Yeah, it's something I've been asked about a few times, and I was recently asked about how to design a wealth tax that would actually work. Now, I'm not really an economist or academic, but in my view, a really good wealth tax is the most difficult tax to design. Now, this is largely because it's really difficult to administer. You've got huge problems around valuation, and so you'd have to design some sort of formula for every type of asset. And as we know in the current world, asset types seem to just appear from nowhere without us even knowing about them. The other thing with a wealth tax is that it can only really work properly if you get rid of every other type of tax. So if you've only got a wealth tax and there's no income or capital gains taxes, then that's a system that could work, and it's said to be the fairest type of system, albeit we can't actually design it properly. Now, that left me wondering what a perfect tax system would really look like. Have you ever had any thoughts about that, Rehana?
Well, you touched on it earlier, Roger, and I would love to see more simplification versus what feels like constant sort of tinkering around the edges and actually just making it more complex. There are definitely way bigger brains out there when it comes to this stuff than mine who can comment on probably what it should look like. Certainly our tax law, I think, is one of the most complicated set of tax legislation out there, and certainly one of the most voluminous. And I think if we can somehow get closer to simplification of some of that, I think it would be much more preferable. It's been commented on so many times that Labour have the opportunity to really do something a bit different with our tax system, that they could, have the opportunity to make some bold changes for the longer term. And I think we've all been waiting for that. I think we'll have to see what happens. But someone who is actually looking for a bit more simplification is none other than Donald Trump. And you might question his motives. However, as part of his election campaign, he said he's been looking for simplification for American citizens living abroad through ending double taxation. Now, I think that's quite a simplified view of things because there are lots of things that impact how US citizens abroad are taxed. At the moment, Americans have a citizen-based taxation and are taxed on worldwide income regardless of where they live. And they also have to file a tax return every year. So his proposal is aimed at the millions of Americans who are currently living outside of the US who are eligible to vote. So it's probably for him a bit of a vote winner if he can kind of convince them that this is the right thing to do. And actually, over the years, there have been lots of groups in the US who have argued that a residence-based taxation would be fairer. It would reduce the admin burden as well as potentially reducing some double taxation. Currently, the details are a bit scant, but whether or not it will see the votes trickle in for Trump for those living outside of the US will remain to be seen. But I'm sure as the US election approaches, we will hear more on that and more from our colleagues in our US-UK team who will be very well versed on what's going on in the US.
Certainly looks like the US is running to the wire on its presidential election.
The Tax Factor.
Well, that's nearly all we have time for this week. We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever is most convenient. We record them and release them in less than 24 hours, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review.
We've just released a new episode of our sister podcast, Brave Business, presented by Declan Curry. This episode is about the business case for sustainability. Everybody talks about it, but what do you actually have to do beyond the cliches? And how can you prove that you mean what you say? Joining Declan are Jim Brown from Blick Rothenberg, Charlotte Pumford from Vivo Barefoot, and Paul Lewis from Seismic. It's well worth a listen to see how businesses, including our own, are approaching this topic. Like The Tax Factor, it's available on all podcast platforms and on our website.
Next week, our media star Matt is back alongside Neil Insole with our pre-budget episode. Will all of the details have been leaked by then? We'll have to wait and see. And don't forget, we've got a budget special the morning after the budget, October the 31st, with our first thoughts on the budget announcements and impact.
That will certainly be a brilliant episode. But from us, it's goodbye or au revoir and have a good weekend.
That's The Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on The Tax Factor.